Credit default swaps are also known as protection policies. Transactions in the marketplace are typically referred to in terms of either buying or selling protection. This can be confusing, since a seller of protection is assuming credit risk and is therefore in an equivalent risk position of being long a bond, but on a synthetic, unfunded basis rather than on a fully funded cash basis. All CDS transactions are bilateral contracts documented under an ISDA master agreement, where the payout or performance is linked to the performance of a credit claim, known as the reference obligation, issued by a third party, referred to as a reference entity, or in cash market parlance, the issuer. Any claim is made against the contract counterpart and not on the reference entity, thereby enabling the separation between creditor and risk bearer. So what are the cash flows of a generic CDS contract? Under a typical default swap, the protection buyer, who is synthetically short credit risk, pays to the seller a regular fixed premium in exchange for agreeing to pay a contingent floating payment to the protection buyer for any losses due to a credit event of the reference entity. If no credit event such as a default occurs during the life of the contract, the swap is one-sided and the premium payments are the only cash flows that are exchanged. If a credit event is triggered, the contract terminates and a physical or cash settlement is made. At this point, the protection buyer stops paying the regular premium, and the net loss to the protection seller is therefore par less the recovery value on the delivered obligation. For physical settlement, the protection buyer only needs to pay to the protection seller the accrued premium up to the day of the credit event and delivers a pari passu obligation of the reference entity in exchange for the protection payout, which is typically equal to the notional principal amount. If cash settlement is elected, the seller pays the buyer the difference between par and the recovery amount, which is valued via a dealer auction process. What is the key distinction between cash and physical settlement? Following physical delivery, the protection seller has recourse to the reference entity and the opportunity to participate in the workout process as owner of a defaulted obligation. What is the SNAC, the Standard North American Contract, and the European equivalent? Effective on the 8th of April 2009, the trading of credit default swaps has taken new standards set by ISDA in order to increase transparency, facilitate processing, and mitigate the hurdles towards a future central clearing system. The reason behind this change is, again, to make outstanding CDS contracts more fungible in the marketplace and making netting of risky positions in trading books and at the central clearing system easier. The new standards follow a new set of rules, such as fixed coupons of 100 and 500 basis points instead of having their fixed lag payment schedule struck at the prevailing fair spread. What are the main uses of credit default swaps? In short, the CDS can do almost everything that cash securities can do and more. From the protection seller's perspective, a major attraction has to be the fact that they are unfunded credit participations. There's no exchange of cash consideration up front, hence leverage and yield enhancement is possible for long risk positions. This is also an advantage for those who have high funding costs, because the CDS implicitly locks in the LIBOR funding to maturity. Moreover, they are customizable contracts, although a deviation from the standard may incur liquidity cost. When trading the credit spread, relative value opportunities may also present themselves as dislocations between cash and CDS prices arise. This is known as trading the default basis. More on this shortly. From the protection buyer's perspective, credit default swaps have revolutionized the credit markets by making it easy to short credit. Users are able to hedge and/or mitigate credit exposure by synthetically transferring single name or portfolio credit risk, or used simply as a tool for those wishing to take a bearish credit view with the added advantage of not assuming any repo risk typically associated with short cash positions. More specifically, from a bank's lending perspective, CDSs can be used to sell the credit risk anonymously in the marketplace without losing the issuer-client relationship. The universe of users is broad, ranging from banks and hedge funds to insurance companies, asset managers, corporations, and government agencies. Each type of participant will have different economic or regulatory motives for wishing to take positive or negative credit positions, whether it be to assume, reduce, or manage credit exposures. Banks are without doubt dominant players with substantial market share as protection buyers. Their focus was initially on achieving regulatory capital relief and portfolio transactions. Today, their usage has migrated to economic capital relief and single-name transactions, becoming active protection sellers and using the process to facilitate primary market syndications. Insurance companies are also very active participants, though due to regulatory constraints on outright derivative usage, some of their activities have been limited to assuming risk via wrappers such as credit-linked notes or investing in various tranches of synthetic collateralized debt obligations. Hedge funds have, without doubt, been behind the phenomenal growth of the credit derivatives market in recent years. They use CDS not only as an alternative way to buy or to sell credit risk, but also to trade correlation and volatility. Other uses involve combining either long or short CDS positions against offsetting cash equity or equity derivative positions in capital structure arbitrage opportunities. The contingent claim associated with a credit default swap is triggered when that event occurs on an obligation of the associated reference entity. These obligations are usually limited to borrowed monies, such as bonds, loans, or credit guarantees. For market standard contracts, failures to perform under a trade payable or receivable contract or derivatives transaction is not considered a credit event. However, such a situation may likely lead to a future credit event. So, what constitutes a credit event trigger? A credit event is most commonly defined as the occurrence of one or more of the following: failure to meet obligations when due, after giving effect to the grace period, such as principal and/or interest. Bankruptcy, for non-sovereign entities, either voluntary or involuntary filings, or moratorium for sovereign entities only. And last but not least, material adverse restructuring of debt. In terms of cash flow profile, a credit default swap is most readily comparable with a par floating rate note funded at LIBOR or an asset swapped fixed rate bond financed in the repo market on the same underlying. This relationship provides a fundamental linkage between CDS premia and asset swapped spreads. There are frequent occasions, however, when the spreads on the two instruments dislocate. The difference between the asset swap spread and the CDS premium is known as the CDS basis. If the CDS premium is higher than the asset swap spread, the basis is said to be positive. In this instance, bonds are trading rich to the CDS. If the CDS is tighter, the basis is negative. What are the influencing factors that drive the basis? What drives the basis positive? Firstly, shorting credit in the cash markets can be expensive or not possible due to the associated costs of repo cover and rollover uncertainty. Such constraints do not exist in CDS contracts, making buying protection the preferred method of shorting credit. This typically drives CDS spreads wider than bond spreads. Secondly, the cheapest to deliver option for the protection buyer. Here, the buyer of CDS protection is long an option to deliver the cheapest of a basket of pari passu deliverable bonds following a credit event. Thirdly, new bond and loan syndication activity. Bond syndication desks may buy protection to hedge forthcoming issuance causing CDS spreads to widen, or following a large syndicated loan, there may be increased short-term demand for protection from banks in the syndicate, again leading to higher CDS spreads. So what drives the basis negative? Over and above simple supply and demand metrics, one must also consider the funding costs associated with going long credit risk in the cash markets. For those participants that fund themselves above LIBOR, it is cheaper to obtain exposure to credits by selling protection rather than by buying bonds directly in the cash markets, thereby driving the CDS spread lower. This situation is not too dissimilar to the more recent dislocation observed in the credit markets, where the combination of a lack of funding availability and high credit spreads pushed the CDS basis into deep negative territory. One must also consider what happens to accrued interest differences on default. In case of default, bonds do not pay accrued interest while CDS contracts do. This is best illustrated by example. Consider an investor who owns a bond hedged with a CDS contract. He risks losing accrued interest on the bond while having to pay accrued interest on the CDS to the protection seller in case of default. Therefore, the investor needs to be compensated by means of a lower protection premium. This drives the CDS bond basis more negative. Another point to consider is the joint default probability and correlation of both the reference entity and the protection seller. Here, the buyer of protection faces greater uncertainty following a credit event should the protection seller default on the back of the reference entity credit event before paying any contingent claim. Therefore, protection buyers will, as a form of compensation, tend to be only willing to pay a lower premium, reducing the basis. Basis trading is taking advantage of these spread dislocations. In a positive basis trade, the CDS trades above the cash equivalent spread. The potential arbitrage trade is to sell the basis, and that is, sell the cash bond and sell protection on the same reference name, and thereby locking in the positive spread differential. The expectation is that the bond will underperform or the basis to converge, narrow towards zero, or indeed go negative. In the event of a negative basis condition, the potential arbitrage is to buy the basis, that is, to buy the bond and buy protection on the same reference name. Here, the expectation is that the basis will widen, and that is, move from negative towards zero and then into positive territory. Such a situation occurred during spring and early summer of 2008, when the generic benchmark CDS spreads were trading 50 to 75 basis points under comparable bonds. The idea was that over time any spread differential between bond yields and CDSs would disappear. These trades were highly leveraged, which came back to haunt the arbitrageurs as the credit crisis deepened further. Significant volumes were unwound in the markets as funds scrambled for liquidity to face the impending barrage of redemptions, forcing the basis differential even wider. As losses ensued, prime brokers requested additional collateral, prompting a further unwind, creating the largest historic basis widening to approximately 275 basis points. Not all trades are guaranteed to win.